$1 million is not enough to retire on. Because of inflation, that $1 million is not going to go as far as we once thought it would. In today's video, I'm going to break down the number you need to retire on comfortably. What should be your target? Now, as we get into the numbers, I'm going to go over something called the 4% rule, which is a calculation that tells you how long your money will last in retirement because you're going to stop putting money in and now you're going to be drawing it out. All right, now let's get into it. Let's talk about that $1 million. I'm going to show you why it is not enough, why it's not going to go very far. Now, there's something called the 4% rule. That is a number a lot of advisors use to determine how your money is going to last over time. If you had $1 million, what the 4% rule says is take out 4% of that each year and bump it up a little bit each year because we need to adjust for inflation over time. So the first year, you're going to take out $40,000. All right, that's 4% of $1 million. Well, I don't know many people that are excited about retiring on $40,000 a year. And let's keep in mind, as you get old, life gets expensive, right? I've got blood pressure medication, you've got Viagra you got to buy now, maybe you've got a fancy scooter. I mean, you've got all these other expenses you weren't thinking about. So how far is that $40,000 going to actually take me? Not very far. So how do I need to know what I need in retirement? How much do I need to have saved? Well, let's start with how much you want to live off in retirement. Let's start with that question first. Okay, if you know the amount you want to live on in retirement, that will drive the amount you need to have saved. So let's say you want $100,000 in retirement. Now, to get to the number of how much you need to have saved, we will divide that by 0.04. That gets us $2.5 million. Say it another way here is, if I have $2.5 million, how do I get $100,000? Well, we're going to times that by 4%. We're going to take out 4% of that each year. That is going to get me $100,000 in year one. Hey, I'm cutting in here because I want to make sure you know all the stuff I'm talking about on my YouTube channel, investing in alternative assets, whether it's real estate or private funds or private equity, oil and gas, crypto, saving on taxes, all these concepts I love and I talk about here. I want to let you know we do this at my company, Directed IRA. So get on over to directedira.com/call and book an appointment with one of our self-directed IRA specialists that'll help you understand how to take control of your retirement. Now, you might be asking yourself, well, Matt, why are we using this 4% as the magic number? Well, the reason we're using 4% is it's a conservative number you can rely on as you're building your retirement account to say, I can at least take out 4% of what I'm making. So let's go back to the $1 million account so we can all do the math here. You took out 40 grand, 4%. Well, if you got a 6% return, your $1 million account actually went to $1,060,000. So if I took out 40, I'm really sitting at $1,020,000 now. And that's good that the account actually went up in value because I need to combat inflation. Now, if you took out the full 6%, that's fine, but you're going to start depleting the account over time. So we want to take out a lesser amount than the return is that we're getting. You can accelerate this. Later on in life, as you hit your 80s at least, you should be pulling out more than the return that you're getting. If the account's in the multi-million dollars, you should be pulling out more unless you want to leave it on for your family or you don't need the money. But you should feel free starting to deplete the account, all right? Because you're not going to need this to keep growing forever. You will expire one day, all right? So let's keep that in mind. You can draw more money out on this later on. But in your 60s, you might be like, no, I'm not going to draw out more. I want to continue to grow this account balance. So the 4% is a good conservative number to start at. Now, a couple quick tips, because the immediate question I typically hear is, well, Matt, how do I get to that number? I'm only at $300,000 right now, or I have nothing in a retirement account. How do I get to that number? Well, it takes two things. First, you've got to start saving. You've got to start putting money aside and doing the work. I know it is short-term pain, but you will have long-term gain and reward on this. Using retirement accounts, you're able to do it in a tax-efficient manner. So start maxing out your contributions, particularly if you're someone who's behind. You need to start getting focused on this if you want to have a retirement you're actually looking forward to. The second thing, besides starting to contribute or maxing out, to look at is getting a better return on your investments, being more engaged in your investments. Too many people put money in their retirement account and it's in some ETF or some target date fund. They don't even know what it is. So get focused on your money. Be focused on what it's invested into. Maybe you even want to invest it in real estate or into a private company or in a crypto or other alternative assets. You can actually do this with a self-directed IRA, which is our company Directed IRA and what we do every day. But whether the stock market's for you or some private alternative asset like real estate or a private fund or a startup or private equity, whatever the asset is you want to invest in, we want to get a higher rate of return so we can build the account. Not only for building the account, but also as we get into our drawdown phase. Now, when you hit retirement later on, you might want to get into more conservative conservative investments, investments that are easier to get out of. You may not have a 20 or 30-year investment horizon to get liquidity in this asset, but we can start positioning us into more conservative investments as you get older that is more liquid, so you can draw and actually start living off of that asset over time. All right, now two other points because they relate to this specifically is I want to make sure I understand Social Security is not something you're going to rely on in retirement. The average Social Security check is $2,000. $2,000 is not enough to live on comfortably. And who even knows if Social Security is going to be there in 10 or 20 years? The government's already telling us it's going to be bankrupt, so I wouldn't be relying much on Social Security. You need to have another plan and another source of income. And what is the number one place most Americans are already relying on? It's their retirement account, okay? It's tax advantaged. It's a great way to build long-term wealth that you can rely on in your later years. The last thing to think about is equity in a home. For many Americans, the equity in the home is their greatest source of wealth. You can tap into this equity as you get older, whether you're selling the home, using the sale of home exemption, so you pay no capital gains tax on that. That's $500K if you're married, $250K if you're single, no tax on gains up to that amount. Or if you want to continue living in the home using a reverse mortgage to start drawing out the equity in the home so you can start using that equity to live on in your later years. But keep in mind, the retirement account and your retirement savings are going to be your number one source to ensure that you have a comfortable retirement, one that you're actually looking forward to. Now, I hope this video was helpful in giving you perspective on what to expect in retirement and how much money you need to have set aside. For more tips on building wealth, saving on taxes, protecting your assets, please subscribe to my channel. I'm Matt Sorensen. We'll see you next time.